Most Americans are making a deadly mistake and destroying their 401ks. This silent killer is quietly draining away hundreds of thousands, even millions from their future. What is it, and how do you fix it before it's too late? Let me show you. How do most people choose their 401k investments? They go to their 401k page, check the returns for each, and pick the one with the highest past returns. What's the danger in that? It's in the disclaimer. Past performance does not guarantee future results. Just because a fund performed well, past tense, doesn't mean that it will continue to do so. According to Jack Bogle, the founder of Vanguard, even if the fund you picked crushed it over the past 10 years with staggering 25% plus annual returns, it's highly unlikely to repeat that performance in the next 10 years. Why is that? More often than not, the fund's success has more to do with luck than skill. If your friend flipped heads 10 times in a row, does that mean he'll repeat that performance in the next 10 flips? Probably not. The same applies to these funds and their performances. To make matters even worse, these funds with the hot returns are usually expensive because they are actively managed. Actively managed means that someone with an Ivy League degree at Wall Street handpicks the stocks that go into these funds. These guys don't work for free. They often charge more than 1% per year, regardless if they do well or not. Paying 1% per year in fees is like buying a Hershey's bar for $100. To add insult to injury, these funds usually suck. S&P Dow Jones determined that less than 10% of these actively managed funds actually manage to beat the market over the long term. Luckily, there's a solution for this problem: low-cost index funds. Low-cost index funds are a cheap way to get the average market return, which most people fail to get. The funds follow a market index like the S&P 500 index, which tracks the performance of the top 500 US companies. Not sure if something's an index fund? Look for clues in the name, objectives, or summary. They will typically say something like, this fund tracks the XYZ index. If the fund's expense ratio is also less than 0.1%, you're golden. Another popular option is target date funds, TDFs. These are more expensive than index funds, but a lot of people like them because they're very hands-off. How do they work? As you approach your retirement date, TDFs automatically shift their allocations from high-risk, high-reward to safer investments. They offer a one-size-fits-all approach based on age. But the reality is, one size doesn't fit all. Let's say we have two people, Jack and Jill. Jack is in his early 40s and just started investing. He doesn't want to work during retirement and he's willing to take big risks to try to get there. Jill is also in her early 40s and just started investing. Unlike Jack, she isn't willing to take on big risks, even if it means she has to work in her retirement years. Although they are the same age, they have very different goals and tolerance for risk. So why should they have the same TDF? That's like saying most Americans develop diabetes around 45 years old. So let's just drug the hell out of everyone over 45, even if they're perfectly healthy. Your investment portfolio should be personalized based on things like your goals, current position, and risk tolerance. Lastly, people often have a fatal misconception about TDFs. They think that TDFs are safe investments. They're not. Even though they should become less risky as you approach retirement, they can still take a catastrophic blow and drop 20 to 40%. This is exactly what happened in 2008. People woke up one morning and screamed, "Where the f*** did my money go?" If you were already retired, your retirement would have ended faster than a celebrity marriage. But what if I told you there is a loophole that you could use to protect your retirement? Not many people know about this. It's called an annuity. If you had one during 2008, you would have been relaxing at the beach while the rest of the world fell apart. Our next video will break down how this hack works. If you're not subscribed already, make sure to subscribe.